Okay, so today we are going to dive into a wealth report. A wealth report is a comparison of putting the same amount of money into an index universal life policy as three other financial options. And that way you can compare the tax-free income in retirement and ultimately to help decide what the best option for your situation is. I'll also show you how you can get your very own wealth report customized for you with no charge and no obligation. Stay with me and we'll dive in. Okay, so this here is our wealth report, and you can download this right from my website if you wish. Here's a few details about myself. It also highlights my financial planning team. And let me just show you the highlights of what to look at. So this here, the report summary is on page 4. So we'll start here. And what this shows is that this is a hypothetical 45-year-old who wants to save $25,000 per year into an IUL or maybe put into some other options. So, what this report will show is exactly how the numbers compare between the 4 different options. The tax rate is 28%, and again, a lot of people believe that taxes will be much higher in the future. I'm one of those. I do think that with all the money that we're spending, tax rates will be higher when we retire, and we're also going to lose a lot of our key deductions, like the kids will be moved out of the house may be paid off. If we're not working anymore, we're not contributing to any tax-deferred accounts, so it's a good chance that we're going to lose our deductions and rates will be higher, and it makes it that much more important to at least have a portion of your portfolio protected from taxes. And this IUL would be a tax-free bucket of money to use. So we're comparing apples to apples, so we're saying that these 4 options get the same, earn the same 6% interest rate. And we'll go over the expenses as well. They're included in the IUL. In the IUL numbers, include them, and then it's we're assuming a 1.5% tax or expense rate in these other options here. So key takeaway, putting that 25 grand away per year to age 64, and then at 65, we could take out about $69,296 tax-free per year in retirement income. So if we compare the 4 options, the first thing that you'll notice is that the income from the IUL is about 1.4 million and change, much higher than the other options. There's also a death benefit. At 85, you got a $598,763 death benefit as well with the IUL option. So you can see here the total benefits, and then we'll also cover the total fees as well, the taxes, and we add these 2 together to get our cumulative fees. And probably what's most important to people, people have a higher fear of running out of money than they do actually of dying in retirement. So with the IUL, we never run out of money, whereas these other options we would run out at 75 or 79 respectively. So that's a quick summary. And then again, you can read through this report. There's a lot of good information about tax rates, and the reason why we use an IUL for part of our retirement savings is that it does protect us from higher taxes. There's no stock market risk like there would be in other options, so it protects us there. Longevity risk, again, it'll provide income longer than other options, so that's why we use the IUL as well. And IULs generally earn a pretty good rate of return that will outpace inflation, so it helps protect against inflation risk as well. So let me go down to kind of the meat of the report to show you what to look at. This is like a yearly breakdown, but I think the best place to really see the comparison here is page 13. And what this does is it'll show you the exact numbers between the IUL, which is here in green, and you want to focus on the cash value account and then the death benefit here. And then it compares it to a taxable account, which would be like an after-tax stock trading account or something like that, compared to a tax-deferred account, which would be like a 401k or IRA, and then compared to a tax-free account, which would be like a Roth. We can't put this much money into a Roth, but if we could, this is how it would look. And we can see here's the the age after the first year. The person's 46. They're putting in $25,000 per year. And one thing that you'll notice is that, one big difference is that, remember, the IUL is life insurance. So you put in $25,000, and if something happens unexpectedly, your heirs would receive a $607,000 tax-free death benefit, where in these other options, there's no death benefit. So they would just get the money back plus interest minus any expenses. So anyhow, so if we go out here into the future, one thing you'll notice is that as we fund our IUL, if it's designed correctly, and that's a key part of the IUL story, is that it does need to be designed correctly to maximize the benefits for you, the client, and that's exactly what we do. But as you can see here, the death benefit does grow. So, by the time this person's 58, they have, $1 million plus death benefit. And then in this example, we show them, at age 64, they stop funding it. They don't put any more money into the IUL or into any of these vehicles. And then we show an income coming out of the $69,296 at age 65. And you'll notice that this report goes all the way, it stops at 95, but this 69,000 and change can be pulled out every year down to 95. And if you live beyond 95, you can still continue to pull this income out of your IUL. But probably the most important thing to note is that if we pull the same 69,000 out of this taxable account, the money runs out at age 75. We're out of money here. So that's, obviously a big problem. And then looking at the tax-deferred account, we would have to pull out $96,244, pay the 28% tax on that to equal the $69,296. So our 401k, we pull out this $96,000, and this also runs out at 79. And pulling the same $69,000 out of a tax-free account, this also runs out at 79. So you can see it's a huge difference having your money last to 95 or beyond versus having it only last until 75 or 79. So that's kind of how the income works and the comparison in terms of getting tax-free income out. And now if we look at the summary here, at age 95, if you're fortunate enough to live that long, you've put in $475,000. You've pulled out $2.148 million tax-free, and there's still a $380,000 death benefit that would be paid to your heirs. You can see what the difference is here in pulling money out of the other accounts. And again, these accounts ran out of money way up here. So the other important highlight to notice is that there is a myth that I hear all the time that life insurance is very expensive. So if we look here at page 17, this shows the exact expenses and taxes paid in each of the 4 vehicles. So when people say life insurance is expensive, I would completely agree, but it's only expensive in the initial years. And the reason why is that life insurance policies are front-loaded with fees, meaning that you pay more in the initial years and less in the later years. So if we look at year 1, we put $25,000 in. Our total expenses here in the life insurance is $46.68. That is a lot more than $811, $552, or $398. But that's not the full story. If you're 45, there's a good chance you'll have this policy for 40 years or more. So let's go out 20 years into the future. So here at age 65, we've paid a total of $84,540 in fees in our life insurance policy. And if we look at our taxable account, we've paid much more than double that in fees and taxes. So $201,000 here. In our 401k, $180,000, and in the tax-free option, $110,000. So 20 years out, life insurance is much less. And then let's go out another 20 years. See here, by 85, we have $138,000 in fees and life insurance. In our taxable account, $280,000. If you're putting all of your money into your 401k, just be aware that there's fees in there, but more importantly, you've got to pay taxes on all the money that you saved into your 401k plus all the growth in that. and it kind of becomes a tax time bomb when it's time for retirement. So if we look at this, $638,000 you paid in taxes and fees on this account, and then on the tax-free option, 183. So you can see how the how it compares. So if we go down here to age 95, we've paid $295 in the life insurance option, $280 in the taxable account, but remember it's kind of irrelevant because this ran out of money all the way up here 20 years before, and then our 401k $638 and then $183 in the Roth or Roth equivalent. And one thing I'll note is that if you have longevity in your family at 95 or after 95, the only fee in the life insurance policy is this, depending on the company, but in this particular company that we use, there's only a $90 fee. If this continued to line to age 96, 97, you would only see a $90 fee, no other fees. So at this, after 95, the growth in your IUL would increase much more dramatically because there's really hardly any fees at that point. So anyhow, that's how the fees compare. So don't let another advisor tell you that life insurance is very expensive. You need to look at the whole picture. And then one other thing I'll highlight is what the returns are. There's many different indexes that you can use. Each company has, on average maybe 5 to up to 12 or 15 different indices that you can put the money in. And if we just look at one of them available with this company, what we did is that we looked at rolling 12-year periods. And 80% of the time, this index hits 7.81%. 90% of the time, it hits 7.47%. When I say hit, I mean average. So that could be 0 one year and then 15% another year. But the average return, 7.47. And 100% of the time, or worst case scenario, we average 6.42%. And remember, this this comparison was run at 6%. So again, these are, we don't know what the future holds, but these could be very conservative numbers. And you can see here maximum return, the average return. And then if we compare this index against the S&P, this index would have outperformed the S&P 500 almost 84% of the time. So in summary, that's that's what the wealth report is. It does a great job of comparing the income between all four options, the death benefit, and also the expenses. So we help a lot of clients get these policies put in place. And if you would like a wealth report for your own situation, just drop me an email or phone call, and I'll be happy to put this together for you. I can tell you that I've had my own IUL for over 9 years now. It's performed much better than I expected it to, and it's been a great asset to have. So I'm definitely well versed in putting these together, and will always do what's best for my clients. As I'm a fiduciary by law, I'll always put your interests ahead of mine, and set this up to optimize your cash in retirement. So feel free to reach out with any questions. Always happy to help. Thank you.